Investors back the jockey, not the horse. Remember, the slide is just there for support. Just had to adjust our mindset to ensure that we're aligning with the investors.
If you've ever wondered how one gets investors to pour millions of dollars of venture capital into a business, you're in the right place. Hi, my name is Zambian Fintech, and it is my absolute pleasure to bring you the Kind Regards podcast, where we discuss navigating career, life, and everything in between. Today's episode is a sequel to a conversation we had last week with Muchu Kaingu, the founder and chief technology officer of Lupiya, a Zambian Fintech that recently raised over $8 million in venture capital. Isn't that amazing? In this episode, we discuss the nuts and bolts of raising capital. What metrics are investors interested in? What unwritten rules of the game should you be aware of? Do investors come to you, or should you pursue them like you would a cold glass of water in a desert? If you're interested in the responses to any of these questions, stay tuned. But first, if you haven't listened to the previous episode, I suggest you start there. Let's jump back into the conversation. I'm keen to know how you've gotten the balance right on having a shoestring budget and getting the best people. From a user perspective, right, when I look at your platform, it looks good. It gives you what you need to achieve what you're looking for on the site. It's quite seamless. So you can tell that you have some really good people behind the scenes working on this thing. So how did you get that right on a budget?
In the beginning, it was Evelyn and I playing multiple roles. So we are your typical octopuses. So we venture into all sorts of different things. And even when we're hiring the first team members, we're looking for individuals such as ourselves who could do multiple things. And we're fortunate to find such versatile individuals. It is difficult, I'll tell you, to find such individuals. They are rare, but when you find them, then you leverage them to the best of their abilities. And they enjoy that because that's how they are built. If you give them just one thing to do, they'll get bored. But if you identify them and give them a vast scope of work, then they feel fulfilled. So yeah, that's how we manage the shoestring budget. But there's only so far you can stretch individuals. So then we're now at this stage where, at least now that we have the funding, we can also build capacity in the team.
It sounds like an interesting place to work. What have been some highlights of your journey so far? What are you loving about this path?
Well, the first one is just that fulfillment that comes with having impact, the impact that we only dreamt about when we started with that $500. And now seeing it play out as real, tangible impact, that is really exciting for us and really fulfilling. And that proving this model works is also something that's exciting. When we started, like most entrepreneurs, you start with a thesis like, okay, if we do this like this, then it's going to work. But you're not really sure if it's going to work until you try it out, right?
Yeah.
So over the years, looking at it play out, dreaming something up, creating it, and then seeing it play out quite the way you envisioned is quite fulfilling.
And the fact that you guys are even expanding beyond Zambia is amazing. Is that something that you always had as part of your vision for the company?
Yeah, so we've always been ambitious. We always wanted Lupiya to be a Pan-African proposition. What we didn't plan for was for Lupiya to potentially scale out of Africa. Now we're seeing opportunities, even in the Caribbean, where people are reaching out to say, hey, we believe your model can work here. So that is quite exciting because that part we didn't plan for.
Muchu, I'm curious. How does one get themselves in front of investors? Do you go to them? Do they come to you? How did you go about it?
Yeah, so it's a combination of things, right? There isn't like one way that you get investors. For us, we used a cocktail of approaches. One was just cold calling or cold emailing investors, just going on LinkedIn and seeing who's investing in Africa, who's investing in Zambia. Like you see like a deal is announced in Zambia and then you say, okay, who are the investors? So maybe that's the second approach where you actually ask for the intro from who they've invested in. At least that softens the landing. And then the third approach is inbound. So basically put putting yourself out there, events, pitch competitions, a lot of PR, like that Kamala Harris visit. We made a lot of noise about it, put ourselves on CNN, put ourselves on a lot of international media coverage. So then the investors then get curious to say, okay, who are these people? What is this company doing in a place called Zambia? So they get curious and then they reach out from that perspective as well. And then the fourth one is also our current investors doing introductions to other investors. So I think that's one of the key aspects of finding investors is you want to get investors that have networks or can unlock networks for you to tap into for future fundraisers. So those would be the four.
Which one was the most successful? And did you try to raise capital within Zambia?
The most successful one, obviously, would be the intros from current investors or from the network of partners like Google, because the investors would then trust their investor friends. It makes the conversations a lot easier. And then we did try to get investment from Zambia, but I think in terms of VC, Zambia is still nascent. So either the deals, when you try to structure them, they're not structured right. Like I remember a conversation where one investor said that they wanted to invest, but they wanted majority shareholding right off the bat. They wanted control. So like they were asking for a lot of things and without like considering like what we wanted to achieve. So already that was like a big red flag. And we said like, okay, obviously this is a marriage that's destined to fail. So we ended up passing on those investors. And then you also get a lot of investors as well. Like they want to add you to their pipeline so that they can then source funding. So they don't have the funds as well just yet. Then they sort of are using you as a poster child. So in that case, there's a lot of time wasting, consumes a lot of time. And it would just be great if people would be like honest right from the start, like, okay, this is where we are at as well. Because then from us, we've got like expectations in terms of timelines of closing the investment round.
You also mentioned cold calling. What's your typical cold call like?
Yes, there's more cold emailing than cold calling. So it's like we have an email version of our pitch deck. So basically just give the investors like, oh, hey, just an introduction, Lupiya, this is what we're doing. These are the important milestones that we've hit. And in there now you do like the name drops, right? First company to be backed by Google. Then you put some highlights on the Kamala Harris visit. And yeah, so basically that's what it looks like. And then now right at the bottom, then basically requesting like a bit of FaceTime, like, can we do an intro call so that we can tell you a bit more about what we're doing?
And what was your success rate with the cold emailing? Like if you were to estimate how many cold emails have you sent out, did they lead to anything or was it almost like a networking exercise of you just getting your name out there?
Yeah, it's, to be honest, just getting the name out there. Like none of the ones that we cold emailed like went far. Some were fortunate enough to get like 20% of them responded to, like, oh, okay, tell us more and whatnot. But then it's really difficult, like from the investment perspective, to then like make like real strides from that perspective, at least from our experience. I know some people might have a different experience, but just even from the traction perspective, like getting 20% response rate, and it's also telling as well.
Just to like bring the conversation back to where we started, you say the introductions were the best way to get meaningful funding, right? Which speaks to the importance of relationships and all of that. How did you get the first one that led to the further introductions and further investments that you got? What's the one that made the big difference?
Yeah, it's interesting that even the first one was from a network, because early on in our entrepreneurial journey, Evelyn and I were part of accelerator programs. Being part of those accelerator programs is that you get informed of opportunities. So the first one wasn't actually an introduction, but we got the news of them looking for companies to invest in through that network. But then they had an application process, so we applied. So basically, yeah, that would be the fifth one as well. Like just looking out for opportunities that you can apply for, because that's how we got the first one, and that's how we also got into the Google Black Founders Fund.
It sounds like one of the best ways for people who don't have those relationships that they can leverage yet is to get into accelerator programs. And I see a number of them. All right, so let's dive deeper into the funding aspects of it. What are some of the key matrices or attributes that investors look for in a startup?
The first one is not very apparent, but it's right there. Investors back the jockey, not the horse. So the people behind the business. So it's really important to have the right people in the business, because ultimately investors bet on those people to make it work. They realize that business is not straightforward. It has ups and downs, but if you back the right people, they will be through those ups and downs. So it's in terms of that, the attributes of those people. One, perseverance is super important because you want people who are there for the long haul. You don't want to give a company a lot of capital and then the founding team then easily backs out. They want people who are performance driven because ultimately they're looking for a return on their investment. And then most of the investors that we deal with look for alignment in terms of impact. Business has ceased to be just a profit making machine. It's also about doing good. Business is a mechanism for doing good in the world, changing the world for the better. So ultimately, a lot of the investors we talk to look for founders that share those values. Then beyond the people, it's about traction. What has the company been able to do with the resources that it had, albeit a shoestring budget, as I initially indicated? But with that shoestring budget, what were you able to do? How did you get the business moving forward? And there, what investors are really looking forward to seeing is if you did X with Y amount, when we give you our investment, how can that investment then catalyze that growth? And that's why traction is important, because the investment is really about, depending on the stage of the business, like the stage where we are at, it's really about taking what works and then scaling it up. So traction is important. And then market is also important. How can this business grow? Like, what's the customer base and how many people are in that customer base and how much money can you ultimately make from that market? And that's why you see that it's also a part of this conversation to scale Lupiya to neighboring countries as well. All of that effort speaks to the element of wanting to increase the captive market. One of the other key things is, what does the competition landscape looks like? And then what are your key differentiators? Competition is great for the consumer, but not so great for a company, because then it just waters down all your revenue generation and profit generation. So how can you then differentiate yourself so that you can create a nice niche market within the broader market? Those are a few of the things, but in great detail, there's a few other things that investors would look for. But then maybe just to add as well, two key ones that I should perhaps not forget to provide is the problem, which is right there at the top together with the team. The problem that you are solving. Is your business a solution looking for a problem, or are you starting with the problem? Like, typically investors will look for a well-defined problem, and then after the problem, then what is your answer to this problem? So what is your solution? I suppose in a nutshell, those are some of the key things, but there's a broader view of other things that investors will be looking for.
How have you managed the pressure of obtaining external funding and large sums of it? How have you managed that?
I think you ask a broader question, which is, running a startup is definitely involving. It really requires that element of resilience. There's a lot of heartbreaks in the process, as not every investor will be aligned with what you're doing. Not every investor will understand it. Not every investor will believe in what you're doing. So you have to be able to take a lot of no's before you get to your yes. Ultimately, it's a learning process, because all of those no's teach you something that you could definitely improve. So you're always emerging stronger on the other side if you don't lose heart. And just like the business itself, sometimes you make losses. And that's why one of the things that I mentioned earlier about the team behind it is, it shouldn't be a team that easily loses heart, but should have solution-driven mindset where whatever shortcomings they face, they're able to overcome those shortcomings. And then it's patience as well, being in the business for the long haul, understanding that it's not a fly-by-night sort of operation. You need to take time to build trust in your community. And this is trust with your customers, trust with your partners, trust with your employees, and now, more importantly to your question, trust with investors. So there is a lot of due diligence that goes into the process, ensuring that what you're saying is actually in the business. As you've seen news around Africa, it's sometimes what people say is not what is within the business. So foreign investors have to do aggressive due diligence to make sure that their bases are covered. So it's not an easy process. It's very involving, very time consuming. And remember, you're also balancing this out with running the business and ensuring that it remains on track. So you have two full-time jobs. Fundraising is a full-time job, and also running your business is a full-time job. Add that to the fact that I said that we're dealing with multi-talented people, so we expect that they're doing multiple roles within the business. So you would be sometimes doing 6 or 7 jobs, and you are expected to still thrive. And yeah, it requires a lot of stress tolerance.
Before we get into the next question, I'd like you to clarify something. So you've mentioned different types of funding rounds. Earlier, you spoke about going through your seed funding, and more recently, you've talked about going through Series A funding. What's the difference between these two types of funding rounds?
One of the primary differences is that the seed round comes earlier in the business. So basically, you've got a smaller customer base, smaller transaction volume. And basically, at that point, you're getting investors to help you build your business model. At the Series A stage, typically this comes after you've already raised a seed round. You've proven that your seed round helped you build your customer base, helped you acquire what is called product market fit, which means there's a significant number of customers that find your offering useful and are paying you for it. So the Series A round then comes to then amplify what is already working, so to scale it up. So those are the key differences at face value between the two rounds. There are a lot of other technical nuances just based on the volume of funding that you're raising at the two different rounds. So typically you find that at Series A, you would have more than one investor, and maybe at the seed round, you have one investor or a smaller number of investors just because the ticket size is small.
Can you describe your approach to pitching to potential investors?
Yeah, so one, having a clear problem, defining the problem in a way that is easy to understand for the investors, then putting a clear solution to solve that problem, and then letting the investors realize that this is a huge market, a huge opportunity, then being very upfront and transparent about what the competition landscape is like and showing your key differentiators. And there, it's a trap because people get tempted to trash the competition. And I don't recommend people do that because investors are smart. They will always figure it out that, oh, so you find that company says like, oh, the competitor is Google and Google is not doing a good job. Like, obviously, that's not a great claim. So the approach to just show your differentiation without trashing the competition is super important. And we put traction. We really put strong traction numbers in our pitch just to show like this is how far we've gone. And in there, we show like our financial performance. We also show the awards, media announcements, all the PR stuff that we do. We show that traction. And then we also put the team front and center, just emphasizing the strengths of the team behind this.
How do you condense all that information into a document that speaks to your audience and gets you what you need?
Yeah, so remember the slide is just there for support. Early on, I was advised not to rely on the slides to tell the story. Ultimately, the person who is pitching have to give a lot of detail, and the slides are just there for support. So basically, that's how you condense that information, because one thing that you don't want is your audience to be reading your slides and not listening to you.
And how has external investment impacted how you do business?
One, it's bringing a lot of structure into what we do. As part of a growing business, there are a lot of expectations in the way we do things. When we started out, obviously, there were things that we were doing right, and that's why we were able to get early stage investors as well. But as the business grows, the reporting requirements become a bit more stringent. Governance becomes a very key concern. So it's really about gradually improving the business through the stages up to a point where you have these things, if not perfect, almost perfect. Because if you think through the funding journey towards maturity, then you want to take the company public. And at that point, then you want to ensure that you have all the right checks and balances to make the general public feel comfortable and confident in your business.
What's something about the funding process that surprised you that you think every entrepreneur should know?
I'll say this in stages, right? Because at every stage, you get something that you didn't know and you learn something new. In the early stages, it was how important traction is. Maybe because we watch a lot of TV. So you watch TV and you see like, oh, someone is pitching an idea and they're able to get X amount for that idea. The reality in Africa is that your business should already be generating revenue. Like, it's very difficult in Africa to get an idea funded. Investors want to see that traction. So that was surprising. But then when I thought deeper into it, then it stopped being surprising and just had to adjust our mindset to ensure that we're aligning with the investors. Then at Series A, one surprise was that Series A investors will not look at any business that is generating less than $1 million in revenue per annum. It's like a hard number, like it's almost a rule, but not out there in public. So learning that was surprising, but then we just had to also adapt to that reality.
Oh, wow. It's so interesting that you have such an unwritten rule that you won't even get your foot in the door if you're not even making $1 million in revenue. And that's quite a big number, especially when considered against like our local currency. Beyond expanding beyond Zambia and possibly into the Caribbean, are there any other plans for the next phase of growth for Lupiya that you envision?
The other aspect of growth is broadening our product offering. So we'll be soon launching a wallet and a card. And this then becomes our neo banking proposition that would lend you the money, and that money is then disbursed into your wallet. And then you can then use your card to transact. So that's very exciting. Tied to that as well is leveraging your wallet to then being able to invest on our peer-to-peer platform. So consolidating the ecosystem into one value proposition for our customer, which is being able to manage their money in one platform.
How do the extended product offerings that you've described tie back into your wider problems statement?
To answer that question, I must go back and state what our actual problem is, which is that financial services in Africa are inefficient. You still have people queuing at ATMs to withdraw cash, still have a lot of transactions that happen in cash. Loans are not inclusive and they take a long time to be approved. So all of these are encapsulated in our problem statement that financial services are inefficient. So if you look at our overall value proposition, by having this wallet that enables you to quickly access a loan, to invest in our platform and earn a very good return, or just transact and manage your transactions or manage your budget. All of this speaks to the efficiency. And doing all of this online without any physical touch points also speaks to that efficiency that we would like to see in the African landscape. We often talk about what has happened to Africa post-COVID. Right now, I can pick up my phone and press a button, order a pizza, and it will be in my office in 10 minutes. But unfortunately, financial services are not that advanced. So we would like to get to the point where financial services operate as easy as ordering a pizza or as easy as hailing a cab.
Moving on to the next segment of our discussion, which is basically covering the fact that you and your co-founder and CEO are married. And I feel like we couldn't finish this conversation without touching on how that dynamic works, right? So many married couples are hesitant to work together. I've literally heard of people who met in the workplace, but because they got married, they literally changed jobs. What has been the key to maintaining a successful partnership while building and growing a company together as a couple?
Yeah, so like you rightly put, this is a really loaded question. It's multifaceted. Some of the things that come to mind, and we get asked this question a lot, like it's really about aligning initially. For us, right in the beginning, we're looking for the sort of partner that we could do business with. So that was important for us because we knew at an early stage that we wanted to go into entrepreneurship. Back then, it wasn't clear what form or shape that would take, but it's just that both of us are inclined to solving problems in unique ways. So yeah, that was important getting into it. I'm not sure it would be very easy to retrofit that. So if we're not looking for that type of partner and then now try to retrofit it post-marriage, I think that would be very difficult. But part of the thing that makes it easier is that we're already aligned from that perspective in the beginning. The other one is business is about partnership. Business is about people, great people. And if you entrust your life to someone, that means that you've said that that person is a great person. And who better to do business with than a person who you've already vetted as a great person? The trust aspect is super important. You trust your partner with your life, therefore you can trust them with your business. It makes doing business a lot easier. And if I'm not in the business, I trust that my wife is running the business properly. And similarly, if she's not in the business, she trusts that I'm running the business properly. There is the balance between work and life. That one is very difficult because sometimes you wake up thinking about the business and the conversation starts very early in the morning about what we're going to do next and whatnot and ends very late at night. So some of your dreams will also be about work. Yeah, but it's a balance that we're learning to have, just trying to be intentional about wanting to keep work, and the home, because we also have children. So we are alive to the fact that the children also need our attention, and it can't be just business throughout. That's a challenge that we are still learning to overcome. And then the last piece is just it's about respect. It's respecting each other, and also ensuring that we have each other's best interest at heart. So the other thing is also realizing, I think this speaks to your earlier question, realizing what our key strengths and competencies are, and ensuring that we play roles in the business that speak to those key strengths and competencies. So that's how we've made it work, and that's how we are continuing to make it work as well.
I see. Thank you. You make it sound like marriage is good for business. So, yeah, thank you for sharing that, Muchu. So, on this podcast, we have a tradition where you leave us with a quote and a call to action, which is something that we can implement following the episode. So, what's a quote and a call to action that you have for us today?
For me, it's one mantra that has kept me going and also keeps me humble, is something that Steve Jobs said a long time ago about staying hungry and staying foolish. A perpetual life learner. I always look for opportunities to learn, look for opportunities to grow. And when I fail, I ensure that I fail forward. That element of staying hungry and staying foolish is super important, because then you know that wherever you are is not the stage that you have to be, that you always have to keep moving forward.
Especially the bit about staying foolish, right? Because sometimes life will knock you down and you become pessimistic and afraid to go for stuff. So that's a good one. Do you have a separate call to action as well?
Once you've been knocked down, not to lose heart, but just keep going, right? And it's perhaps one of the other elements of wisdom that were imparted to me by a mentor earlier in the journey. And it's like, anything can happen to you, just don't get knocked out of the game, right? Because when you get knocked out of the game, that's game over. But as long as you still have that element of the fight still left in you, you can live to die another day.
I love it. Speaks to resilience once again. Thank you so much for making the time to talk to us today, Muchu. Really, really appreciate it. And looking forward to seeing all the great things that you have planned for Lupiya coming to pan out. I think your story is really inspirational to not just entrepreneurs in Zambia and in Africa and really across the world, but, to people in general, to think that you can take a seemingly simple concept and achieve great things and have a great impact on your respective communities. So yeah, thank you so much.
Thank you for having me, Zamiwa. I really enjoyed having this conversation.
Thank you so much for tuning into this episode of the Kind Regards podcast. I hope you found it valuable. And if you did, please share it with a friend. I hope you have a great week ahead and carry Muchu's overall theme of resilience with you. Kind regards, Zamiwe.